Let me ask you a question. How can you be earning money, paying your bills, and still receive a weak approval or no approval at all? The system may not be seeing your full financial position. It may be seeing a limited snapshot of your financial life. I stay on top of how these systems read balances, payment patterns, inquiries, cash flow, and account activity. And the part most people miss is that the bank is not seeing the entire story. It is seeing the version of the story that reached its system. Today, I want to show you what banks are actually seeing when they review your financial position and why that snapshot can produce a weak approval, even when your real financial situation is stronger than the system believes. And there is one part of this snapshot that can make you look more exposed than you really are. It has to do with what gets recorded when it gets recorded and what the institution assumes from that record. I've got to say that again. The system may be seriously judging the snapshot, but not the full position. So let's get into it. Let's start right here. A financial snapshot is the limited collection of data an institution uses to evaluate risk at a specific time. That's it. Not your whole story, just a snapshot. There is a difference between your full financial reality and the information the institution actually sees. There is also a difference between when that information was captured and the conclusion the institution draws from it. Depending on the product, the institution may look at your reported credit balances, your utilization, your payment history, recent inquiries, account age, and new accounts. It may also look at public records, stated income, bank statements, existing obligations, deposit patterns, and even business revenue. Now, here's where this gets important. The snapshot is not identical at every institution. A credit card issuer, a mortgage lender, a bank, and a business funder may each use different data, but the principle is the same. They are making a decision from the information available to them at that moment. Now, the snapshot is not necessarily false. It is incomplete, and it is time-bound. Let's talk about 3 distortions. 3 very important distortions. First, timing. You may pay a balance before the due date, but a different balance may already be reported before your payment shows up. The institution evaluates the reported balance, not your intention and not your later payment. The statement closing date is often when the balance used for reporting is captured, while the due date is when the payment must be made. These are not the same date, and reporting practices can vary by issuer. Second, context. The bank sees a balance. It may not see the balance was used for inventory, payroll, travel, or a temporary business expense. It may interpret the same data differently depending on its risk model. Third, fragmentation. Your income may be spread across personal accounts, business accounts, payment processors, and investment accounts. The first data set the institution receives may not include the full business or personal context behind that activity. A strong overall position can look unstable when the data is separated. Now, your financial behavior may be completely reasonable, but the recorded pattern can still trigger a risk interpretation. Signal 1, high reported utilization. Utilization is based on reported balances, not whether you eventually pay in full. A high reported balance can make your available credit look tighter than it really is. The issue is not automatically debt. The issue is how the system reads the ratio. Signal 2, frequent applications. Multiple inquiries or new accounts may feel like expansion to you. The institution may read the same activity as increased dependence on credit. Business growth and personal credit activity can be read very differently by the system. Signal 3, cash flow volatility. Strong monthly income does not always look the same as consistent, predictable income. Large deposits followed by large withdrawals can create a different risk picture than stable, recurring cash flow. The bank may see the movement without seeing the business reason behind it. Signal 4, mismatched financial layers. Personal obligations may be reported in one place. Business revenue may sit somewhere else. You may feel financially strong overall, but the institution may evaluate each layer separately. Now, when this strategy works best, let me tell you this. Before you apply, there is one question you need to ask. What version of your financial position is the system actually seeing? So before you ask an institution to make a decision about you, inspect the snapshot first. Check number 1. What balance is currently being reported? What balance appears on your credit report? What balance was present around the statement close date? Does that reported balance reflect normal usage or an unusual month? Check 2. What does the institution see as new? Look at recent inquiries, new accounts, recent credit limit changes, recent account closures, sudden increases in reported balances. Check 3. Does the income story match the account story? Look for income deposits that are hard to identify, business revenue that separated from business expenses, irregular transfers, large, unexplained deposits, personal and business activity mixed together. Check 4. What conclusion could the system draw? Could this look like dependence on credit? Could this look like unstable cash flow? Could the institution see high exposure? Could the data look inconsistent across accounts? This is not about hiding information, manipulating numbers, or misrepresenting your finances. It is about understanding the data that is already being used to evaluate you. So now let's be clear about what this does not mean. Do not believe that every denial means the bank is wrong. Do not believe that a better snapshot guarantees approval. Do not believe that moving money around creates genuine financial strength. Do not believe that one credit score tells the entire story. Do not believe that the same snapshot is used by every institution. And here's what not to do. Do not falsify income. Do not hide obligations. Do not open accounts simply to create the appearance of activity. Do not apply repeatedly without understanding the reason for the denial. Do not treat timing strategies as a substitute for cash flow strength. The goal is not to create a better looking story. The goal is to understand the story the system is already reading. Picture this. A viewer earns well, pays obligations, uses credit for legitimate business activity, applies for funding, and receives a weak approval or a denial. He assumes the institution has judged his character or his ability, but the actual issue is that the institution interpreted a limited snapshot. The real lesson is this: a financial system cannot respond to the full person it cannot see. It responds to the data pattern in front of it. That does not mean your effort was meaningless. It means effort and positioning are not always the same thing. Same person, same habits, but different positioning, and that makes all the difference. You've probably been told your problem is discipline or budgeting or simply working harder. Those things may matter, but they may not be the root problem. The deeper issue may be a financial system that has not been shown to you yet how to flow inside it. So I built a free tool to help you identify which layer is creating the most friction in about 5 minutes. It's called the CBL Financial Positioning Diagnostic. The link is in the description. There's no cost, no pressure, but major clarity. Now, This video gives you the lens, but the complete CBL Wealth Blueprint is where you identify how your credit, business activity, cash flow, and financial identity are interacting. The goal is not simply to look better to one institution. The goal is to build a financial position that works together. Do me a favor real quick and subscribe to this channel. Hit the like button because we want many people to see this so that they'll be on top of this information just like you. Drop me a comment below and let me know, have you ever felt like the bank was judging your financial position from information that did not tell the full story? Comment the word snapshot below. And here's what I want you to remember. Banks do not see your entire financial life. They see the snapshot their system receives. Understand the snapshot. Understand the interpretation. Then position yourself with clarity. You, my friend, will win. Be blessed. I look forward to seeing you again real soon.